So welcome back to another market recap. We have quite a bit of an up and down week so far. We were in the profit and then we had a couple of losses which brought us back down to break even, and now we're currently sitting at 2% in profit. So we're going to go down to trading view once it starts loading, go through all the trades that were taken this week and the ones that we're about to take. We're going to show you all the losing trades. We had 3 losses and 2 wins, and currently we're sitting at break even right now, so just waiting this to load and we'll go through them all. So we'll start off with Euro Swiss. That was a buy position and that was plus 4%, so let's just quickly have a look at that. And then we've also got a pair that we'll go over at the end that is very soon to get entered, but again, it'll be a buy position if we manage to get the right entry signal. But Euro CHF, if we go to that quickly, that was, of course, a buy that we took. Where we took that buy, let me just double check. So, that was the 24th. We took that at 9396. So this is where we entered. I think that we got in somewhere around here and we managed to bank plus 4% on that one. So that was a nice trade. We had seen multiple bottoms in the market that had been caused. Technically, you could have argued this would have been an inverse head and shoulder. You would have had your shoulder, you would have had your head, you would have had your other shoulder, and then we had a nice, would have been a dragonfly doji is what you call that one, where the body of the candle is actually in the top third of the actual full range of the wick, and then the wick to the downside is actually going to be between 2/3 upwards, showing that the sellers tried to take control. The buyers pushed them back out of the market. We closed near the open, so as you can see here, because it's a white candle, the signals that we're going up. So the bottom is the open, the top is the close, and you can see that the sellers just weren't able to maintain control, and then we managed to get in a buy position. There was nothing really fancy on that setup or that entry, but we managed to bank ourselves 4% on that trade. So moving on to USD Swiss, that was a minus 2%. We got a buy trade for that, so let's just quickly go to that. That hit our stop loss, so that brought us back to 2% for the week. You'll be able to see let me just double check. As you can see, yep, we actually entered because we had a support zone, and I think it was around about these areas here, and then we had anticipated that once we had, you know, these 2 pushes away and then this other third push away in the form of what could be argued as a hammer candle, but we'd sort of want for a hammer candle the body of the candle to be a little bit higher with less of a wick up top, but nonetheless it does show that the buyers have slowly started to take control here, forming a double bottom on a key area support and inside a descending wedge pattern, which is squeezing price action. And when it's squeezing price action in a particular direction, you can see the pulses are getting smaller and smaller and smaller, and typically what you'll see is you'll see a break to the upside. But it's not just something to trade off of its own, a pattern of its own. You need to, of course, add in a confluence, like for example this support zone that we managed to find on the daily, and you can see always look left to get confirmation of zones and levels. The last time that we touched this in a bullish fashion, we had a massive rally, and if you can see here, we'll quickly just look at the price range from the bottom to the top. Not saying that this is going to happen this time, but 426 pips, so we know that it's a very relevant level. You can see we've got touches in here, and being on the daily time frame, they're big sets of data, so each candle has obviously got a lot of data in it, and if we've got multiple touches on the daily, then we know that it's a valuable source to be making trades off of. But we really do want to be looking for as many confluences as possible. And as you can see here, we actually, for me, took a buy position on this hammer candle. See, this is, I don't think it really gets much more perfect than this candle, this hammer candle. You see the sellers really, the length of the wick on this candle is extremely big, so that's a great sign that the market's got excited. It's tried to push price down. The buyers have really rejected that a lot, and you can see the candle body is closed on the top third of the full range, so that's a great sign. That was the entry signal. And then of course the fact that we have created a double bottom here on a key area of support, and the fact that we've done this inside a descending wedge pattern. So these are three confluences to get in that trade, and that entry signal was the last thing that we needed. As you can see here, we actually got in. It looks like we've broken the pattern, but not only have we broken the pattern, it looks like we're going to respect the break, which is what counts, because we could easily do this like what we've done up here, and then just slowly start to come back in, and then come back up to retest it to say, okay, are we coming back inside again? And then price action goes down further. But just while we're on this trade, we're currently 2.5% in profit, so break even for the week so far. With this one running, we're 2.5%. But if we could quickly just go to the dollar index, because of course this is going to be a big driving factor for all the dollar pairs. As you can see here, we've had a nice little bullish run up, but if we go and zoom back out and we can see the bigger picture here, you'll be able to see that we've been in a downtrend for a long time. We've been in a downtrend for an extremely long time, and just the way price action's behaving, the pushes down lower, as you can see here, the gap between that's quite a big one, the gap between this one's quite a big one, and the gaps are getting smaller and smaller and smaller. And instead of actually coming down more like this, we're sort of starting to round off, and then that's when you'll get that push up. Because what happens is, if price action is hitting levels at the top of the market and we're looking for sell positions, it will typically drop fast. But if you're looking for, say, buy positions at the bottom of the market, typically what will happen is it will start to round off and then it will take off. So this is one thing to be wary of, is when you're at the top of the market and you're looking at breakouts of patterns, or you're looking to take trades off levels. Just bearing in mind that in sell positions are typically move to the downside quite sharp and quite steeply, and then of course on the flip side, if you're on the bottom end of the market and you're looking to get in the buy position, you will see, typically speaking, not always, but the majority of the time, you'll see that rounding in off at the bottom of the market, and then you'll start to see price action move up. It's that old adage that bulls run up the stairs, bears jump out the window. So price action always rounds off at the bottom of markets, especially in patterns and at key levels. And on the flip side, if you're in a selling position and you're at the top end of the market, price will typically move a bit sharper. But so with that running position that we have, US dollar Swiss, we're currently sitting about just over 2% now, and we have had 3 losses and 2 wins. So we've done Euro CHF, we've done USD CHF. Now let's go to GBP Aussie sell. That was a -2%. That also hit stop loss, so -2% for GBP Aussie. You see, it wasn't really a fancy trade, but what happened was, you can see we had that ascending wedge formation. We had very many double tops on the hourly. We had a couple of double tops. You see we had a double top here, and then typically one could argue that this was a double top here, like a quadruple top in a row. And then what happened was, we have broken out this pattern, and we started to use this little mini trend, and all we've done was coupled up, this has actually been changed since the trade's actually taken place. We took off the old analysis, but this is typically what we'd be looking for if price action was to give us another sort of entry. But what happened was, we were looking for a bounce off this trend line, we're looking for a bounce off this trend line in line with a key resistance area. So, and we actually did, we got that entry signal. I think it was this here. Yep, it was more this, and then we had, I think we had something. Yep, that was more the level here, because we're looking at these tops, and then these wicks to the upside. You can see it's a very well respected level. So it was, we had very good reason to take that trade, because we did eventually see that shooting star entry signal, which, as you can see, they're all telling the story. They're telling the story, especially at key levels, that prices tried to push up. The sellers are telling the market that we're not going to take this price higher, and we're going to push back down, and we're going to close below, and that's typically what we're looking for at key areas like this. Not all confluences are the same. Not all levels. Like you could have a level that meets up with a resistance. You could have a level that meets up with a trend line on one pair, and a level that meets up with a trend line on another pair. One of those setups is going to be way better than the other, just by the significance of the level, how much it's reacted to in the past, and how much it's reacted to on in the future, because that's what you really need to be looking for, is how much is it actually reacting to, and what's happening right now. Because if price action, if it's not relevant right now, if a level is not relevant right now, then it's absolutely useless to you. It's only useful if it's relevant right now, and you can go back over time and have a look and see, okay, what has price action done when we've hit these levels before? What have they done, coupled up with the fact that they've hit a trend line, coupled up with that support resistance zone? And then you start to factor in patterns, then you start to factor in candlestick formations, and then entry signals. So that for us was enough to get in that trade. But again, market will literally do whatever it wants to do. So let's just put that analysis back, and then that hit our stop loss. So minus 2% for that one. And that's broke, so I think we might actually go higher on this, so not one I'm looking at anymore. Oil, we hit stop loss on oil. This was a nice trade actually that just did not play out. So let me have a wee look. So yeah, it was this one here? I think it was, we'll find it right now, because we used the Fibonacci on this, and I think we took it from, because see, this is what we were looking at this point. Let's just take this here. At this point, I think we had like this. So when we were looking at the market, we're sitting there thinking, right, we have this is our push phase, and as you all know, we have push and we have pull phases. So this was the push phase all the way down here. So if this is the push phase, we're saying that this is going to be the new market structure, because we've had a massive bearish leg down, right? And typically you will have that push, and then that pull, that push, and then that pull. So this is going to be the push. You'll have the pull, and then typically you'd have the other push. So to use the Fibonacci, and what that's good for is that's obviously good for finding levels. So what happens is you take this here from the top, because this is the push. If the push is in a bearish trend, if the push is going down the way, you take it from the top to the bottom. And if this was flipped on the reverse side, and we had all this price action but it was moving up, we'd take it from the bottom to the top. Okay, so in this case we're taking it from the top to the bottom. So we've got to the top of this wick to the bottom here. And then what happened was, I think it hit on this level. This is where, because I remember 0.618 Fibonacci retracement, which is the golden ratio, is typically the one the market likes to go. And I say typically very loosely, because obviously it doesn't happen like this all the time. There will be those times where it hits maybe the 0.382 or 0.5, or I might have an extremely deep retracement to go to the 0.786. You just never know. So that's what we're looking for. And if we just Okay, so let me go back. Yep, I think yep, that's what we took. We took this trade here, so it was off the 0.618. We had this here, and this is what we were looking for. We hit off at 0.618. This was the push, this was the pull, and then we had that entry signal here, that shooting star candle, and it's actually a really good shooting star candle because it's, you can see there's like a minute little wick at the bottom there, but it's basically nothing. This is again telling a story. The price has tried to push up higher. This has been the open because it's been a buying candle. This has been the close. So price has been dominated by the sellers at this level, and because this move to the upside is just going to be technically classed as a retracement to the push phase, that's what led us to get in that trade. But again, as you can see, price action pushed up higher. We were minus 2% on that one, and then we had CHF buy position, CHF GPY. And where did we enter? We entered off this candle here again. Was it this one? No, it was this one here. Perfect. This is what you call a dragonfly candle. Hammers typically got a little box shape like this black one here, a little bit box shape to it. Has a little bit more volume in the actual open and the close, but this would typically be, I mean, you technically could call it a hammer candle. A dragonfly is typically the exact same shape as this, but it's basically, the open and the close are like basically so close together that they're almost like the same line. And that's just, again, telling the story. When they're on key levels like this, when we can really identify areas in the market that are big pivotal levels, we can match them up with trend lines. We know how to understand market structure. We know about volume. We know when the market, how it moves at the top of the market, and we know how the market moves at the bottom of the market. And we know what else? We know that we know to look out for when different pairs, intertwine with each other. So some pairs, like for example, if the dollar is strong, we need to know the market correlations. So if the dollar is strong, where is NZD USD typically going to go? Well, because the dollar is in the second currency in this pair, if the dollar is strong, typically what would happen is the New Zealand dollar would be driven down in price because the dollar is the dominant currency in the markets. And then of course you'd have to factor in what's the New Zealand dollar actually like at this time. Is it strong, is it weak? If the New Zealand dollar is weak and the US dollar strong, that's like a double positive for it to go down the way. I hope that makes sense. But again, we're not going to jump too much into that because plenty of other lessons on that. So overall, we had Euro CHF plus 4%, USD CHF minus 2%, so that takes us to 2%. GBP Aussie sell minus 2%. Takes us to break even, and then we have oil minus 2%, so that takes us to minus 2%, and CHF GPY buy plus 2%, which takes us back to break even. And now we currently have USD CHF entered. So and you see here we're currently in profit. It's a good trade. What I would say about that is keep an eye on the dollar index, because if we manage to break this trend line here, that's really going to open up the gates for bulls. That's really going to open up the gates for a lot of buyers stepping back in the market and really driving price action up. And typically, as you all know, the more videos that you've been watching of these, what we like to do is take targets, very, very long-term targets, but it gives us perspective of the market long-term. Is when you get patterns like this that have been going on for the past year, 31st of March 2021. So this has actually only been going on for March, so give or take, a couple of months. Typically when you get patterns that have been going on and having a clear effect, so a clear downtrend for a long period of time, when you start to see the rounding and off at the bottom here, and then you do get the break of this trend line, what you typically look for is to take price action back up to where it started. So you would be expected that over time the price action will start climb back over that 93 handle, and then maybe a little bit above to match the highs away back in March of 2021. And that's how we could get a good gauge. But this would have to be a convincing break. It would have to have some real convincing signs in volume, and obviously how the market is behaving, what's actually going on in the push and pull phases. Is the push, for example, like a good break would be something that breaks and then of course has a good few candles sort of rounding and off and slowing down. If it goes, breaks, comes straight back down again, that's no good to us, because that tells us that the buyers aren't actually that strong in the market right now. It might be a little bit of market manipulation. It might be a liquidity probe, trying to take some stop losses out before then coming back inside the pattern and then moving downward. So what you don't want break wise is for price to break just the tiniest little bit and then sort of just slowing down here, because you can see all of this candle here has had this whole push phase, and now you've got this little tiny bit on the outside that's managed to push outside the trend line, come back in and bounce off the trend line and then push back up again. So that's not typically what you would look at and say that's an accurate and reliable break. You want it to be pushing up quite a bit past, then you want not an immediate retest, but you want some form of retest, and you want to say, all right, where's price action most likely going to come back to? Okay, let's have a wee look. I can see here straight away, just for training my eye, I'm looking at this bottom here, and then I'm looking at the edge of these candles here and the top of this wick, and I can see them all lining up without me having to really do anything. And that's what I'm looking at. And you're never going to get them accurate 100% all the time. You might have to play around with them and say, actually, no, wait, maybe this is a bit more accurate, or you know what I mean. So it's really just training your eye and then understanding the criteria for trades that are most likely to give you the results you're wanting. Because there could be 5 people right now all looking to get in this trade, all in the same group, and just based on what you know and how to handle your emotions and just knowing little things like that, you want the break to be a considerable bit past, and you also want the candles to show a clear sign that the buyers are actually in control by not coming down, having an immediate retest. And then you don't just want to come back down and watch price action hit on top of the trend line. You want it to couple up with a couple of other confluences, because the more confluences you can get that are accurate and actually are relevant to the trade, then the less this becomes more of a gambling sport. It's more technical, it's more accurate, because you can actually make a lot of money and predict to an extremely high degree what the market's actually going to do before it actually happens. You'll never be 100%, but you could actually predict it very accurately, just by stacking confluences that are relevant to the trade. And that way, when you are putting your money in the market, if you couple that up with risk management, you are making very smart investments instead of just hoping that price is going to go in the direction of the trade that you've put on. Because it might work for a small while, but to be consistently month after month and year after year, you do have to have a system in place, and you have to get very, very good at saying no to trades and being patient and waiting. So currently right now up 2.5%. We do have one other trade that we're going to quickly go over on the ready to enter list, because it is getting very close to enter. But just bear in mind, with this dollar index, we actually do have a bullish dollar entry right now, and this is obviously going to be in favour of a bearish dollar. But that doesn't mean to say that we can't rely on the euro being strong and the dollar could still be strong, and this could still push up. So again, let's just break this pair down real quick. Always start, I mean, you could go in the weekly and the daily is typically the time frames. I'll go out to the weekly. But you can see here, this is just a bearish trend line that's been broken. It's nice and simple, right? We've had that push up, we've came back down to retest the trend line, and then we've moved away. Now, price action ever so slightly is getting squeezed, and we're getting squeezed in this ascending wedge pattern. But this ascending wedge is actually quite a strong pattern. It's not one of the more shorter ones, so there are opportunities to maybe take a short buy position back up to the tops of these highs here. And these are the type of shorter term trades when the market isn't actually moving the way that you would typically expect it to move, or it's maybe not hitting the take profits that you're setting. They might just be a little bit too far away or too unpredictable for the market conditions that are currently in right now. So, and this would be a nice quick short trade. You'd easily be banking yourself a 3 to 1, a 4 to 1 here if we do get the right entry signal, and we need it to be matching up inside the pattern and on this support zone where we created that double top, and we've had another couple of good touches here. So again, very, very probable that price action will bounce back up to this double top here on the bounce of this trend line and this major supply zone. If we get the entry signal, if we manage to get the entry signal, then of course we're going to pop price action back up. We can bank ourselves another 3 to 1, 4 to 1. If you're risking 2%, you're getting 6 or 8% back, and that's a nice quick trade. And then you can just leave your analysis on here, because typically what will happen is we'll see this break eventually, and then we can look for sell positions. But understanding behavioral finance is very key, because behavioral finance, typically putting fundamentals aside, I'm just talking about people reacting in the market. So everybody that trades in the market, they've all got emotions, obviously. So what happens is when you have people that say there's 200,000 people on this trend right now, and you see that big push up, how many out of that 200,000 do you think are going to think, shit? They could be shorter term traders, or they could be thinking, right, okay, I've got my money, I'm just going to cash out now. And then that's what you see, price action push down, and then you'll see buyers go, right, okay, I'm going to get in the market now because this is going to be the second leg up. And then they see price action stalling around this here, and they go, okay, right, it's going to be a double top, so I'm going to cash out again. And then that's why you see, the price push away from this double top. So it's understanding people's emotions whilst looking at the chart. So you could be looking at this right now and you can see people's emotions. There'll be a lot of people in these sells, and then eventually when you do get to areas like this, they'll cash out because they know that there's an opportunity for them to lose the profits that they once had, and that's exactly what they don't want, especially if they are break even, especially if they're coming off the back of a couple of losses. So that is exactly why you need to understand market structure and how other people are going to be thinking, because that's ultimately going to do two things. One, it's going to stop you from placing trades as dumb money, and two, it's also going to help you place better take profits, better stop losses, and also manage your emotions. So this is the next trade that we're going to be looking to take. US dollar Swiss is currently just sat over just over 2%, so we're up 2% for the week. We were 10% last week, so things are going pretty well. But one thing I want to exercise into your head is you're going to have a lot of losses, so you're probably going to lose every single week, but you need to make sure they're minuscule. You need to try and mitigate them as much as possible, and you need to make acceptable take profits, not unrealistic ones where you're leaving them in too long and eventually hit stop loss. And also understand what mood the market's in. Is it trending? And then even if it is trending, is it a typical trending market where like pre-COVID and everything just sort of trended well, or are we in sort of something like COVID terms where the market's a bit more shorter, a bit more choppy, where we're going to have to take those shorter term trades. But again, please don't hesitate for anything question wise or chart wise that we've covered tonight, or just anything in general. It's what we're here for, it's what we like to do. So we'll wait and see how Euro USD goes. We're going to hold US dollar Swifts. Keep an eye on the dollar index, because we might actually see that bullish breakout but if we don't, it's still good to know all angles in a buying and selling market. So until Sunday, where we go back over and do the weekly watch list for the week, we'll see you in the next one. We hope everyone has a good rest of the trading week.